Yeah. But I think as long as there's some, I don't know, if suddenly there's like some sort of consequence and people protesting, whereas people just put up with it. Like when she appointed Lula to the board to shield him from jail, like I think, yeah, yeah, exactly. And someone told me that CFO of Vale is a Stern alum. Is that right? Was a student there. Cool.
Actually, I mean, he got really mad at me 2 years ago because I didn't say picture of my He got mad. He got senior and he said, how can you do this? But you're already in the club. And I said, I'm sorry. But I don't know. This is what I've done. Right after that, Raleigh is like a second child, the youngest child. The older child became all the years, but now he's removed. Now my worry is that
They're gonna take it on Vale. Yeah.
this is my, and I've spoken about it so chart of the red cigar, I know how strong they are. He's from this class.
Wow. That's awesome.
He actually did buy it.
Oh yeah.
What company are you doing? So you have your optimal? So if I called on you, would you be able to? And what's their actual? What's their actual? 8. And your name is? Greg. Greg, ITV, 8%, 30%. I've got it, okay. So what's your optimal? 80%? Which is it? Viacom. Viacom is 80%? How come? They're at 57% right now? It's the cable part of the business. But they also own the cable. But they also have a cable. That's where the 57% comes from. It's not in the Nickelodeon part. No. Right. They have capacity. Okay. So the end of the semester. Can you hear me? No? Have your attention, please. Good. Okay. I'm not sure. Is this working now? Okay, good. What I'm going to say next is going to remind you that the end of the semester is coming up on you, right? It actually should have reminded you last Thursday when I sent that email out saying if you want to take the early final exam, go to the Google, because that means it's coming. And let me tell you how quickly it's coming. It's a week from Wednesday will be a third quiz, right? And about a week and a half after that will be the final class. So basically we're looking at 3 weeks of class left, or 6 sessions basically, right? So this is session 20, going through session 26, which effectively is my way of nagging you saying, hey, and I know most of you are working on your projects, I can tell. I'm not psychic. My email tells me where how far along you are. So I do know you're working on this on the spreadsheets. The only thing I would ask you not to do is don't let them become black boxes. You'll be tempted because you say, it's kind of 40% optimal, let me move on. If it doesn't work, I'll blame his spreadsheet. No, that's fine if you want to blame somebody else, but with every number you get, here's what I want you to do. You got the what, right? That's your. I want you to ask why and what next. With every single number, what, why, what next. If you think about it in those terms, in a sense, it'll make your analysis richer, because if all you're doing is pumping numbers back at me, you know what? I actually have a spreadsheet I haven't released. It's on my, I have it on my computer. So if you break into my computer, you could probably get it. Where if you enter the numbers on your input page, it does the entire corporate financial analysis for you, every aspect of it. For section 1 through section 10, and it'll pump out the numbers. And I'll give it to you. At the end of this class, I will give it to you. You can have it in case you want to do so you can sit down and do a whole corporate financial number crunching, at least, of any company. But this is about you being able to read those numbers rather than just looking at those numbers. Okay? The third quiz actually will cover only capital structure, which means we're very close to being done with the material for the third quiz by today. And definitely by midday Wednesday, we'll be done with everything. So you have a week of so you can basically take a week to catch up on the material. Okay, so let's pick up where we left off. On Wednesday, we were talking about the optimal debt ratio, went through the cost of capital approach, the APV approach, we looked at the sector. Let's say you've done all of that for your company. Okay? You now have a sense of what your actual debt ratio is and what your optimal debt ratio is. Time to tell me what to do next. So, as I said, there are three things that can happen when you do this analysis. One is your company is already at its optimal, in which case, just let go. It's okay. The fact that you don't have much to say in this section doesn't mean your analysis is dead. There are other parts we'll have chances to talk about your company. But let's look at the two other scenarios. Your company has too much debt or too little debt. Let's start with, as I said, the more attractive scenarios. You have too little debt. So let's start with that problem. Let's say your company has too little debt. It's underleveled. The question you've got to ask is, how quickly do I need to fix that problem? And to answer that question, I'm going to ask you a question. Is your company the potential target of a hostile takeover? Why would having too little debt make you the target of a hostile takeover? What is it about too little debt that makes you attractive as a target company? I'm sorry, somebody back there? Why does target? Go ahead.
You can take debt and distribute to shareholders.
When you say who's you?
The company.
But why would it make it easier for an acquirer to acquire a company if it's underleveled? Yeah.
They could use an LBO method.
Yeah, let's not even go the LBO route, but you can borrow money using my assets and essentially use it to. I'll give you an analogy. This analogy is not going to go all the way through, but kind of hang in there anyway. Let's assume you buy a house in the New York area. Even with real estate prices down, it's going to cost you $1 million plus. And unless you're a drug dealer, you probably have to borrow money to buy the house. So you borrow money, you buy the house, and you're very frugal. You save every dollar, every $100, every $1,000, and in 5 years you pay off your entire mortgage. You now own the only all-equity financed house in your entire neighborhood. Congratulations. You decide to have a mortgage burning party. If you don't know what a mortgage burning party is, because it used to be very common in the old days when people stayed in the same house for 30 years and actually paid off their entire mortgage. And the day they paid off the mortgage, they'd have a mortgage burning party where they'd invite all the neighbors over and they'd physically burn the mortgage papers. And once in a while they'd burn the house down with it, but that's a little problem on the side. So you decide to have a mortgage burning party where you invite all your neighbors over, including your neighbor Bob, who's never liked you. He doesn't like the way you cut your shrubs. He's never liked your kids, but he shows up anyway. It's free food. And while he's sitting there eating your coffee cake and drinking your orange juice, he's plotting his revenge. So right after the party, he goes to the friendly neighborhood bank. He says, there's $1 million house in my neighborhood with no debt on it. Could you lend me money against that house? What's a bank go? I told you this analogy wouldn't go all the way through. You go to a bank and you try to borrow money in your neighbor's house. What's the bank going to say? If it's a sensible bank, let's put that prefix on it. It's going to say it's not your house. You can't go around borrowing money on other people's houses. End of the story, right? But let's say this is your friendly neighborhood banker. He says, no problem, Bob. Here's $800,000. He's now borrowed $800,000 against your house. He now does a hostile acquisition of your house. Again, I'm not quite clear how this would work out. But basically, this would mean approaching your kids and giving them, 20, 25, 30% of the, if they own a portion of the house, and you can have the basement or the attic if you sell your share. So he does a hostile acquisition, gets to 51% and throws you out on the street. Thank God this can't happen with a house. But let's make this a company. Let's make this a $1 billion publicly traded company that can afford to borrow $600 million, and you're the CEO, and you hate borrowing money. Why? You just don't like to borrow money. There's no real economic reason, you just don't like to borrow money. So you run an all-equity funded publicly traded company worth $1 billion. It can afford to have $600 million. I see your company. So I can borrow $600 million against that company. I go to the friendly neighborhood bank. Again, the problem I'm going to run into is the bank is not going to lend me money on a company I don't own. But last session, remember, we talked about Mike Milken and the junk bond market. Essentially, junk bonds have always existed, but post-81, Mike Milken created a market where you could original issue junk bonds. You say, how does that help me? Here's what I do as a potential acquirer. I go to the market and I borrow $600 million. Against what? Against absolutely nothing. It's an unsecured bond. Of course, people will charge a much higher interest rate. They'll give it a low rating and a high interest rate. But I tell them, look at my history. I've done this before. Done what before? Borrowed money and acquired companies and paid off the debt. So lend me money at 12%. And you do. I borrow $600 million at 12%. I proceed to use that money to fund the acquisition. And I buy the company. And you're a very conservative CEO, right? So in addition to not borrowing money, what else have you accumulated for me in your company? You've accumulated $300 million in cash. So what do? I take that $300 million in cash and I can pay down the debt. You've essentially greased the skids for me. You made it really easy for me to do an acquisition because you've given me debt capacity I can borrow on, and then I use your cash to pay off the debt I borrowed using your assets. Now do you see why if you're underlevered I have to worry about being taken over? So I'm going to ask you, what is the chance you're going to be the target of a hostile acquisition? Let's see what are the, and so let's make this about your company, right? So think about your company. If you have an optimal, let's go through the criteria that will determine whether you need to do something quickly. Because for many of your companies, your actual debt ratio was lower than the optimal. Let's see whether these criteria will lead you to act quickly. First, I'm going to look at the size of your company. Let me explain. Let's assume you find Microsoft to be underlevered. It is. What's the problem with trying to do a hostile acquisition of Microsoft? Twofold, right? One, you got to come up with like $250 billion. That's a lot of money, even if capital markets are open and accessible. What's the second problem? You got to get to 51% of Microsoft shares to do a hostile acquisition. And an impediment is going to be the fact that Bill Gates, even with his shrunken holdings, and Steve Ballmer and the rest of the insiders, are not exactly going to be welcoming of somebody who comes from the outside saying, I'm going to do a hostile acquisition. Getting to 51% is going to be difficult at Microsoft, partly because of the size of the company. So I want you to start thinking about the market cap of your company. If it's a $10 billion, $30, $40 billion company, not a problem. I can come up with enough money. If it's a $100, $150, $200 billion company, I've got to worry more. I'm going to look at insider holdings, or alternatively, voting structures that are fixed. What am I talking about? Voting and non-voting shares. Remember that corporate governance section where you looked at, can I change this company? This is now going to come back. So those are the first two things you're going to look at, is the size of the company and insider holdings and voting structures. And there's a third factor you're going to look at. Every hostile acquisition is a fight between two sides. On the one side is the hostile acquirer. On the other side are the management of the company being targeted. In the middle, for once in their lives, stockholders are the center of attention. So you guys be stockholders, you be the acquirer, you be the management. And here's how the fight plays out. The manager says, don't sell to the acquirer, he's going to ruin the company. And the acquirer says, don't trust the managers, they don't care about you. And you get to pick who you're going to go with. So let me tilt the scales a little bit. Let's assume that over the last 2, 3, 4, 5 years, your stock is down 80%. Who are you going to trust? I think that if your stock is down 80%, and the manager said, trust me, you're going to say, to do what? To drive it to zero? So the third factor you're going to look at is how well or badly your stock is done after adjusting for risk and after adjusting for the market. Does that sound remotely familiar? How well or badly your stock has done after adjusting for risk and after adjusting for market performance. That's your Jensen's alpha. Basically, remember in the regression we looked at, did your stock, well, it was close, beta, this is the twin to beta, right? If you get the beta, the Jensen's alpha. So essentially, you can look at so by the time you get to this point in the analysis, you're not looking at a blank slate anymore. You know enough about your company where you can make a judgment on whether your company is potentially the target of a hostile acquisition. And if it is, you don't have the luxury of time. You've got to increase your debt ratio quickly. And I'll go through the mechanisms in more detail, but increasing your debt ratio quickly will mean going out and borrowing money and buying back stock. What does it do? Your debt goes up, your equity goes down almost instantaneously. Borrowing money and paying a special dividend accomplishes exactly the same thing because the dividend lowers your equity. Or if you have a small enough company, you can even try what's called a debt for equity swap, which is you go to equity investors in your company and you offer them corporate bonds in your company with equivalent market value. But it works only with small companies. You're trying to do something quickly. So if you're under threat, you have to act quickly. This is what's called a recapitalization. And most recapitalizations are triggered by the threat of a hostile acquisition. When companies recapitalize, it's not because managers woke up one day, looked at a cost of capital spreadsheet, and oh my God, we have excess debt capacity, we've got to do something quickly. It's because they're afraid. They're afraid of being targeted, and they're doing something quickly to make it go away. So that's if you're the potential target of a hostile acquisition. But let's say you're not, because you're too big, you have different classes of voting shares, your family control, whatever it is. You have the luxury of time, right? And that's good to have, because if you're going to increase your debt ratio, you don't want shock therapy. If you go from 0% debt to 50% debt overnight, your company's got to be run very differently. So if you have the luxury of doing this gradually, you should. And in this case, if you're not the target of a hostile acquisition, then I'm going to ask you a follow-up question. Do you have good projects? And I'm not just going to listen to your answer, because if I ask this of managers, they're going to say, of course I have good projects. I'm going to look at your track record. I'm going to look at whether right now you're generating more than your cost of capital. Do you have good projects right now? And here again, we have a number we can use to back it up, right? Remember in section 5 when I asked you to compute the return, I know if you haven't done it, in section 5 when you do compute the return on invested capital in your company, I compare it to the cost of capital to make a judgment on, is this company creating value? If you're a company with a history of taking good investments and you have excess debt capacity, you have a marriage made in heaven. Here's why. Going to your optimal lowers your cost of capital, right? We talked about how much value that adds. If you can borrow that money to go to your optimal and take good projects, what's the definition of a good project in capital budgeting? It has a positive net present value. And what happens the minute you take a positive net present value project? Your value goes up. You get a double whammy. By going to your optimal, you increase your value because you have a lower cost of capital, the tax subsidy. On top of that, now you get to take good projects. Your value goes up. If you have good projects and you have excess debt capacity, the best choice for you is to borrow money and take those good projects. If you don't have good projects, then you have a task ahead of you. You've got to bring your debt ratio up over time. By doing what? By paying more in dividends, buying back stock. You create 5-year plans to do this where your debt ratio increases gradually over time. So if you're underlevered, the trigger is going to be, am I under threat of a hostile takeover? If you are, do something quickly. If not, map out a longer term plan. So that's if you're underlevered. If you're overlevered, you have a different kind of problem. You've got to bring your debt ratio down quickly. And that's actually a little difficult to do. And here's why. If you're overlevered and you have too much debt and you want to bring the debt ratio down, you look at all the usual things, right? In fact, give me some suggestions on what to do as an over-levered company to bring it. There are lots of oil. In fact, I was just looking at the oil sector last week. And in fact, this is true across the commodity space. About a third to 40% of all commodity companies now have too much debt. It's not even debatable. In fact, those of you doing commodity companies, don't be surprised if it's not a big oil company to have too much debt. So you clearly have too much debt. There the question about urgency will revolve around, am I under threat of bankruptcy? And how would you know if you are? What are some of the things you could look at? You could look at the interest coverage ratio. You could look at the bond rating. In fact, today I'm doing my updated valuation of Valiant. I valued Valiant in November of last year, right after the first crisis hit. I valued it at $77. The financials I used in November of 2015 are exactly the same financials I'm using today, 6 months later. You know why? Because the earnings report that was supposed to come out in February never came out. So they're already about 3 months behind, 2.5 months behind. So my numbers look exactly the same. So if I plug the numbers into my spreadsheet, hey, it looks like the stock should be worth 77 still, right? But there's one thing that has changed. They owed $31 billion 6 months ago. They still owe $31 billion today. So that hasn't changed. But that $31 billion is now a clear and imminent danger to them. First, because there is a covenant in those bonds that requires them to file their next financials by April 29th. If they don't file it by April 29th, they're technically in default. The second is, whenever there's delay, this is something I think companies don't factor in. What do markets assume? That you have good news or bad news? Bad news. And the longer a delay lasts, the more you worry about what the hell are you guys finding that you're not willing to come to the market. And this is for 5 days. So you can actually, in fact, I'll send you these studies. If you look at earnings reports, they come out on pretty much the same day every year. February 27th every year. So what the study looks at is what happens when an earnings report is delayed relative to what your expected announcement date would be. And they look at 1 day delays, 2 day delays, 3 day delays. So basically they map out. And the longer a report is delayed, the more negative the price reaction is. And you can see why. You're 2 months delayed. This is beyond the pale. Either they're so completely confused they can't find any of the numbers, which is kind of scary, or they actually know the numbers and they're afraid to let us know, which is even scarier, I guess. So I could wait for the report to come out in like 3 weeks, but by then it's going to be too late. Why? Because once a report comes out, everybody will know. So basically I'm sitting here saying, how am I going to adjust my valuation of Valiant? And I'll talk about what I'm going to do on the income side, but what I did first was I said, that debt that I wasn't as worried about in November of 2015 because it looked like they had the cash flows to service it, I have to start worrying more. And in fact, the ratings agencies put a little prompt to me that they should worry more because the rating for Valiant is now B+. Remember that table I showed you about the probability of default? With a B+, you're looking at about a 20% chance of default. So if I'm sitting there with Valiant, and if the numbers are not coming through, I need to bring that debt down quickly. So help me out here. I'm Valiant, I want to bring my debt down quickly. What are some of the things I could try? Sell assets. In fact, there was a rumor last week that they would sell Bausch & Lomb, which is one of the divisions of Valiant. It's a pretty profitable division, that you could sell the division and get the value and use it to pay. And for Valiant, that actually is not a bad option because there will be people out there who will pay for Bausch & Lomb. And so Valiant actually has options. So when I do my valuation, that's one thing that's keeping me positive on the company, is it can sell. It has assets that it can sell and get cash flows. With an over-levered oil company, though, you see what the problem is? You say sell reserves. To whom? Other oil companies, who are all just as much trouble as you are. It's like being a casino company in trouble. Who are you going to sell the casino to? Steve Wynn, he's in trouble too. I mean, after all these casino companies are run by megalomaniacs who borrow too much money. So if you have too much debt, they're all going to be over-levered. So selling assets sounds awfully good, but only if your bargaining position is not shot to hell. So you could try selling assets, but that might not work for you. So if your company is over-levered, check to see whether their assets are maybe like Valiant, you have an opt-out clause. But if that doesn't work, what's the next thing you're going to try? Yep. Issue stock. Tell me, and almost every path I pick is going to come with all kinds of issues, right? If Valiant tried to issue shares right now, what's the problem you're going to face? People say, I'm not buying your shares. You haven't even released financials. If an oil company tries to issue shares right now, you say, I'm not buying shares in you. So you could try to issue shares, but again, you can see that you're going to be issuing into a market that doesn't want to buy your shares. So it's tough to sell assets. It's tough to issue shares. What's your third option? I'm sorry? Talk to your bank and be very creative about while you're talking. You go to your bank and say, remember that 10-year loan? Could we make it a 100-year loan? And that 10% interest rate, could you just forget the zero at the end and make it a 1% interest rate? This is what they fancifully call, restructuring talks with your lender. You're saying, why would they agree to stuff like this? Because if they don't agree, what do you threaten to do? Go bankrupt. It's like bargaining with somebody with a gun held to their head saying, no, either agree to my, or I'll blow my brains out. It's a threat of throwing yourself into the court system with all the costs associated with it that you're using as your negotiating policy. Give me better terms. And it's amazing how much bankers will, or lenders in general, could be bondholders, will have to give to keep you going. Rather than have you go bankrupt, they will do almost anything they can to keep you as a going concern. And history is full of borrowers who've used, it sounds almost unethical or immoral, but this is your last stand. And what you're using is the threat of, if you don't agree to my terms, I'm done. And lenders and borrowers through history have used this. In fact, my favorite example of all time was in the 1800s. I forget which South American country it was, because pretty much South America has this history. You look at the history of sovereign defaults. It's like South America owns this. It's like a monopoly. And nobody, in fact, any other country anywhere in the world has a sovereign default. It's almost like, how dare you? We own this. So this was in the 1800s. It's some, it wasn't one of the big ones. It wasn't Brazil or Argentina. It was, one of the small. At that time, you didn't issue bonds. They'd borrowed money from a French bank. Why was the French bank lending? Because South America was a long ways away. There was potential and there was promise. This has never changed through history. They lent money, and it turned out the potential and the promise came to nothing. And the South American country was not able to pay back its debt. The debt payment due date comes around. And the South American countries, I don't know how they sent information across, because remember it took a long time to get across, sent the news that they would not be able to make the payment, but they offered to pay with guano instead. You know what guano is? It's bird droppings. You see, bird droppings are great fertilizer. So they said, we have no cash, but would you take bird droppings instead? The first reaction they got from the French bank was, we don't usually get paid in bird droppings. No. And they said, would you like to take that or nothing? The bank thought about it for a moment and said, put it in ships, send it over. Okay, we'll take it. Desperation basically allows you to get the best possible terms. And if that's the case, you have to do it. So if you have an over-levered company, go through it. Start off by saying, can I sell assets? If you cannot sell assets, can I issue equity? If that doesn't work, then think about how could I restructure my debt to make this problem at least go from being an immediate problem to a further away problem. If you're over-levered and you're not under threat of bankruptcy, why? Because you have the cash flows to service the debt. And you could pay off the interest payments. Remember, you can't be forced into bankruptcy just because your value is lower. As long as you service the debt, you're okay. Then again, you have the luxury of time. And here again, I'm going to ask you a follow-up question. Do you have good projects? Using the same metric we did with the equity approach. And if you have good projects, here's what I'd suggest you do. Fund them predominantly with equity. Saying, what equity? I have no shares to issue. Remember, you can do this over time, right? What's the biggest source of equity financing over time? We looked at that chart for companies. It's internal equity, retained earnings. So over time, what am I suggesting? That you take every dollar of earnings you have, every dollar, and put it back into these projects and that'll push up your equity over time. It's the most pleasant way to get out of a debt problem is for your equity to grow you out of the problem rather than have to pay down debt. But that'll also mean that if you're paying nice hefty dividends, stop. If you're over-levered and you're paying dividends, this is like being in a hole and you keep digging. It is going to only get deeper. And that's my problem with a lot of these oil companies that I said that are over-levered. I also checked out whether they're continuing to pay dividends, and many of them are. This is self-destructive behavior. I know they're rational. If I cut dividends, markets will punish me. Why? Oh, it's bad signal. Of what? I know you're in trouble already. If you don't cut dividends, you're in denial. So might as well cut dividends, take your pain and move on. But here you're essentially using retained earnings to push your equity value up. If you don't have good projects, again, you have to devise a long-term plan to bring your debt down. Maybe use your retained earnings to pay down the debt and see if you can kind of move gradually over time. So that's the framework, and I'm going to use it on Disney, and I'd like you to start thinking about your company and what you found for your company and think about where you'd put on the framework. So this is so let me take Disney. Disney, as I showed you the numbers last session, the actual debt ratio is about 11 to 12%. The optimal is 30 to 40%. We can debate whether it's 30 or 40, but it's out there. It's under level. In 2013, do you think Disney was potentially the target of a hostile acquisition? Why not? So let's go down. Market cap, the total value of the firm is about 138 billion. So that's pretty high. So that's already no strike against it. Not much in insider holdings, if you remember, but there are a couple of insiders, and most of them happen to be people you bought companies off, right? One is Lorraine Jobs, who's on top of the list. The other is George Lucas, but he seems pissed off at you after the Star Wars, so maybe he'll sell shares to me. So there it's kind of a mixed mess. There aren't insiders in the conventional sense of managers holding on to the shares. But here's what tipped the scales for me. Do you remember the Jensen's alpha that I computed for Disney about 250 lecture note slides ago? Yes, right? 9% Jensen's alpha. That tipped the scales for me. It's had a pretty good time period leading into 2013. Essentially, in 2013, if you ask me, is Disney potentially a target of a takeover? My answer would have been no, but not because it's Disney. The name alone doesn't protect you. And then if you ask me, do you have good projects? Again, I'd have looked at Disney's own numbers. And if you remember for Disney, I computed return on capital of 12.9%, which is well above their cost of capital. And if they can keep that pattern going, clearly they have good projects. So at least in the case of Disney, my optimal move, if I were Disney, would be to use debt capacity over time to build that new theme park in Shanghai, to make the next Star Wars movie. They have lots of plans to fix the leakage in ESPN, maybe convert ESPN into essentially the equivalent of HBO Go, which is as an app that you pay money. There are lots of things that Disney plans to do. It would be kind of silly to borrow money and buy back shares and then have to come up with the capital to take those. So at least in 2013, my advice to Disney would have been borrow money and take those investments. You're saying, what's so specific about 2013? Remember I said I've done Disney 4 times with each particular book. So let me go back in time. 1997, Disney was under-levered. At that time, its market cap was about 70 billion, which was big by 1997 standards. Not much in insider holdings. Great Jensen's alpha leading into 97. So 97, my advice would have been very similar to 2013. Right after I wrote that first edition of the book, I decided to buy 1,000 shares of Disney because I wanted this to be real. I wanted to feel the pain. God, did I feel a lot of pain over the next 3 years? Because Disney's stock price dropped by 50% over the next 3 years. So in 2000 or 2001, if you'd asked me about Disney, my views about Disney would have changed fairly dramatically. Because its Jensen's alpha had become negative. Its market cap had gone from 70 billion to 35 billion. And remember, these were the days of the dot-com boom. eToys, I think, had a market cap of 25 billion. In fact, my vision of a good day would have been to open up the newspaper and see a headline that says, eToys announces hostile acquisition of Disney. Just to see the looks on these guys' faces, because they seem to be in complete denial. But you could tell by 2001 and 2002 that they were starting to get a little nervous. In fact, I don't know whether you remember, but I talked about that acquisition bid that Comcast made for Disney in 2003, that really insulting bid where they made an offer for the company at $10 below the stock price. course, it didn't go anywhere. But the die had been cast because you could tell that Disney's managers were now terrified. You know how you could tell it? Because Michael Eisner, remember him? Basically ran the company like Imperial Caesar. He started talking about how much he cared about stockholders. He's talking about stockholder wealth. It's almost like somebody was feeding him words. I'll give you a suggestion. If you're tracking a company, if you're a CEO, and this is a company historically has not cared about stockholders, when you hear talk about stockholder wealth maximization and how much you care about, how much they care about stockholders, it's usually because there's something happening under the surface. And I'll give you my favorite example. It's unrelated to Disney. In the 1990s, if you're a European company, I'm talking about mainland Europe, not UK. Hostile acquisitions were an Anglo-Saxon phenomenon. Those barbarians who would do, but in continental Europe, you didn't do stuff like this. It was not polite. So mainland European companies thought they were completely protected from hostile acquisitions. It would not happen in France or Italy or Germany. Of course not. Until a company called Telecom Italia got targeted in a hostile acquisition, where the acquirer actually borrowed money from the bond market. In fact, that's what kept hostile acquisitions from happening in continental Europe, is you had to go to a bank to borrow money. And guess what? You went to an Italian bank and said, I'd like to do a hostile acquisition of Fiat. Well, good luck with that. It's not going to happen. They basically broke through and went to the bond market. They did a hostile acquisition of Telecom Italia. It shook up continental European CEOs almost immediately, because it could happen here. So about 6 months after it happened, there was a panel discussion in Geneva. And there all these CEOs, all these companies gathered together, and I had the misfortune of being master of ceremonies. Why? Because you can never say what's on your, what you're feeling. And as master of ceremonies, you introduce people, you sit down, you introduce other people. I don't know how I even got roped into doing this. And I had the singular misfortune of sitting next to the Siemens CEO. And he gets up, and he says, at Siemens, we care deeply about stockholder wealth maximization. I almost fell out of my chair. I mean, this is a company that has treated stockholders like mosquitoes for decades. You're a stockholder? SWAT. Get out of the way. Here's your dividend, go away. Listening to this guy talk about stockholder wealth maximization, the sensation I had was the same one I had when I listened to Madonna sing Like a Virgin. To which my reaction is, how would you know? What is this, a deeply repressed memory? Okay? CEOs who've never cared about shareholders talking about stockholder wealth maximization is like Madonna singing Like a Virgin. A better song for them would be Britney Spears, Oops, I Did It Again, right? Another big acquisition, Oops, I Did It Again. So when you think about, so that's why, in fact, when you look at your company, don't just track the financials. Okay? Track what CEOs are saying. It's not because they're particularly, I never read a CEO interview expecting deep insight about the company, partly because they don't even understand their own companies. I'm looking for trigger words, things like stock, because that tells me more about what's the CEO most afraid of. And here it means that an acquisition is potentially coming down the pike. So in 2003, when I wrote the second edition of my Applied Corporate Finance book, Disney had become a much smaller company, negative Jensen's alpha, pissed off shareholders. And there, when they had excess debt capacity, as they did, I said, don't go out and take projects. I want you to go out and buy stock today or pay a dividend, because I don't trust you with this excess debt capacity. Nothing is permanent. I mean, there was a point in 2010 when Apple had excess debt capacity. Apple's had excess debt capacity for a long time, and nobody gave them any trouble about it. 2 years later, how quickly changed. Carl Icahn was saying you should borrow money. So nothing is permanent. When you see a company that's underlevered, what you're saying about the company is as of right now. That could very quickly change. So that is if you're, so take your company to the framework, see what you get. If you have an overlevered company, your task is a little more difficult because you have fewer levers under your control. So the objective of this analysis is twofold. The first is you're trying to ask the question, how quickly do I need to fix this problem? Because if you have too little debt or too much debt, you've got to think of it as a problem. You're not using your debt capacity. How much time do I have? With underlevered firms, that's going to be driven by, are you the target of a takeover? With overlevered firms, it's the threat of bankruptcy. If you are in fact underlevered or overlevered, then the second question you've got to answer is, how are you going to change your debt ratio? And remember, there are two broad ways you can do it. You can borrow money or issue equity and take projects, or you can borrow money and issue equity and recapitalize. And which one you will do will be driven by your answer to the first one, because if you want to do something quickly, it's going to be very difficult for you to take a project and bring your debt ratio up or bring your equity ratio up. So that really is going to drive this analysis. So very quickly, if your company has to do something quickly, let's look at the levers you have available. So remember, that's a financial balance sheet that we talked about. You've got assets and liabilities, operating assets, growth assets. Very broadly speaking, here are the ways you can change your debt ratio quickly. You can focus almost entirely on the liability side, forget about the assets, and do recapitalizations, which in the case if you have too little debt will mean borrowing money and buying back stock, or borrowing money and paying a special dividend. That will fix your debt ratio quickly, pure recapitalization. If you have too much debt, it's going to take the more difficult task of issuing equity to retire debt, because you want to bring your debt ratio down. So that's a recapitalization. Everything is on the financing side. If you go to the asset side, then you have to sell assets. So if you have too little debt, you're going to sell assets and use the cash flow you get from those assets to pay a special dividend or buy back stock. That'll bring down the equity. It's not bringing up debt, but it'll bring down the equity. If you have too much debt, you got to sell assets like Valiant was planning to do with Bausch & Lomb, or the rumor was that it was thinking about doing, and use that cash to pay down the debt. Okay. So essentially what you do will very much be tailored to what company you're looking at and where it stands right now, and what you've learned about your company already in terms of performance and projects. So that's why there's a sequence to this that you have to follow, because if you just do the optimal, you're going to be kind of stuck there. How do I know whether my company is a good company or a bad company? Work through the sequence. Any questions? Now, if you're going to change debt ratios slowly, it can be done. It's actually easier to do. But the mechanics of working out the change are a little messy, and here's why. When you change the debt ratio today, there's a stock price today, there's a debt today, you fix everything, it's all today. But if you're going to do this gradually over time, a couple of things are going to happen. One is the equity value that you see for your company will change over time. Why? Because if your cost of equity means anything, remember there's a price appreciation component. Even if you do nothing, the value of your equity, if you've estimated it right, should increase over time by 6, 7, 8%. So do you see what that means? If you want to get to a 40% debt ratio 5 years from now, that 40% debt ratio is going to be much higher than a 40% debt ratio today, because the company itself can be expected to get bigger. So if you're going to do things gradually, you have to, in a sense, do that hard work of estimating what your equity and debt will be over time. So I'll send you a couple of, it's not difficult, it's tedious. You got to work through dividends over time, how will they affect value, how many shares am I going to buy back? But it still follows the same process of changing your debt ratio in the direction you want to take it. So everybody comfortable with the optimal and moving to the optimal? Okay. Now let's talk about the last aspect of the financing principle. Remember the very first class, or maybe the second session, I said the right kind of debt for you is determined by what your assets look like. If you have long-term assets, you should have long-term debt. If you have euro assets, you should have euro debt. So I'm going to start off with why matching debt up to your assets helps you as a company. Okay? In fact, the best way to set this up is to go back to that debt-equity trade-off. So let's go back to the trade-off. What's the biggest advantage of using debt? It's a tax advantage, right? What's the biggest advantage of using equity? Flexibility, which is you don't have to pay a dividend. You don't have to pay a dividend at all. So if you're a startup and I buy equity in your startup, you shouldn't pay a dividend. So the biggest advantage of debt is a tax advantage. The biggest advantage of equity is it's flexible. In good times you can pay a lot in dividends. In bad times you don't have to. What you want with a perfect financing instrument is you want the best of both. You want a cross-dressing security. A security that behaves like debt around you, debt around the IRS. So it gives you the tax advantage and behaves around equity with you. So you want the flexibility of equity plus the tax advantage of debt. You're saying that's impossible? It's possible, but it'll take a little work. And that's what we're going to work towards. So let me set up the reasoning for why matching up debt is so critical. So let's say you have a company. Let's make it an oil company, right? Oil companies' values go up and down as oil prices go up and down. So it's out of your control. It's not like you're not doing a good job. Your value is just going to increase and decrease over time. If this oil company goes out and borrows a fixed amount of debt, and the value of that debt is the same no matter what, it's technically in trouble every time the value drops below the debt. In fact, it is technically insolvent. The value of its assets less. It might not be forced into bankruptcy, but this is a company that's in trouble, at least in those periods where the value falls below the debt. You're saying, so what? I'm going to take the same company and let it borrow money, but in this case, I'm going to assume that I was able to structure the debt in such a way that when the value of my firm is high, the value of my debt goes up, and when the value of my firm goes down, the value of debt goes down. So you're going to see debt go up and down the firm. This firm actually has 1.5 times more debt than the previous firm, but it never goes bankrupt. So in a nutshell, that's why we want flexible debt. If we get flexible debt, we can borrow a lot more money than we otherwise would have, which means that we get less default risk and a bigger tax benefit. It seems like the best of both worlds. So what I'm going to do is take you through a 5-step process for designing debt. And I want you to, again, think about your company as I go through this process, because we're going to do your project while we're sitting there. So if you understand, at least think about what your company does. It'll help in terms of designing the debt. So here's the first step in the process. You're a company. You want me to design your perfect debt. I'm going to ask you some questions. So as I ask these questions, think about your company. Don't think about Disney or Tata Motors or whatever. So the first question I'm going to ask you is, tell me what the typical duration for a project is. Is a typical project for you long-term or short-term? I'll give you 2 examples. If I'm looking at Boeing, what's a typical project for Boeing look like? I think Boeing has had only, 8 projects in its entire life? 707, 727, 737, 747. You know when R&D started on the 747 in the mid-60s? The first 747 rolled off the assembly line in 1972, 73. The last one came out, I think, 30 years later. This project, if you think about it, typical project, if you include the R&D, is probably 50 to 60 years. So what does that mean? When Boeing goes out to borrow money and it asks, well, what maturity should my debt have? Your answer is going to be really long term. In fact, Boeing was one of 2 companies in the late 90s that issued 100-year corporate bonds. Think about it, 100-year corporate bonds. See, what's the other one? The other one was Disney. Boeing, you can explain. Disney will have to come back and kind of wrestle with. But Boeing issued 100-year bonds, and I can see why. Your projects are really long-term. Your debt should be really long-term as well. In contrast, if I looked at, let's say, Google or Microsoft, typical project, because it's a technology company, is going to be much more short-term. And if your project is much more short-term, I would expect your debt to be much more short-term as well. So even if technology companies start to borrow a lot of money, which they haven't yet, but if they do, I would expect their debt to be much more short-term because their typical projects are short-term. So think about your company, think about it. You're saying, what if my company doesn't have a typical project? Break it down into businesses. A typical project for Disney doesn't exist, right? It depends on whether I'm looking at the movie business, the theme park business. On each one, I'm going to have a different one. You don't have to come up with specifics. You just have to think about what is a typical project for my company. Second question I'm going to ask you is, what currency are your cash flows in? And this actually, when you did that equity risk premium for your company, you should have had at least a sense of, right? Because the equity risk premium, I broke down where I got my revenues, and you can at least make a leap of faith, assuming the currencies will match where you get your revenues. The case of Disney, 82% of their revenues came from the US, 18% from outside. So at the very minimum, I can say 82% of your cash flows are in US dollars, 18% are in foreign currencies. If I want to be more specific, I'll have to know which countries those revenues come from, and I should be able. One way to think about this, if you draw a pie chart of where your company gets revenues and a pie chart of the currency in your debt, they should look pretty similar. And if they don't, you should have a really good reason why they don't. Third question I'm going to ask you is, how does inflation affect you as a company? And what I'm asking really is, do you have pricing power? Because if you have pricing power and there's inflation, you can pass it through to your customers. But if you don't have pricing power and there's inflation, you get squeezed. Why? Because you can't pass through on your revenues, but your costs go up. You're saying, why does it matter? This really determines whether you're a good candidate for floating rate debt. And here's why. In floating rate debt, the interest rate of the debt gets reset each period based on what a LIBOR or a prime rate or a 10-year bond rate does. So if interest rates go up, the interest expense on floating rate debt goes up. The biggest driver of interest rates over long periods is inflation. Now, do you see the connection? You're a company with pricing power. You take floating rate debt and interest rates go up. Here's what you're going to do. You're going to take those higher interest expenses and pass them through your customers. But if you don't have pricing power, the last thing you want to do as a company is to go out and issue floating rate debt, because then you're going to get squeezed exactly when you don't want to get squeezed. So what duration for your debt, what currency, fixed or floating rate? Last question I'm going to ask you is, are you a mature company where most of your value comes from assets in place? Remember that financial balance sheet? Are you the kind of company where most of your value comes from growth assets? If most of your value comes from growth assets, you're Facebook or you're Tesla, then I think you're a much better candidate for convertible debt. More Tesla than Facebook, and here's why. In fact, Tesla did issue convertible debt, and you're going to see why. What's the biggest advantage to the company of issuing convertible debt? What does a coupon look like on convertible debt? It's going to be really small. In fact, you could make it vanishingly small by making the conversion option attractive enough, because that adds to the value. You're saying, how does that help me? If you're a growth company, your biggest problem is you don't have much in cash flows today, right? The last thing you want to do is borrow money with a coupon that's high today. So what do you essentially use convertible debt to keep the interest expenses low right now. And if things work as expected and you become a successful company, that convertible debt will become straight debt. But by that time that happens, presumably you'll have the cash flows to service the debt. That's 90% of debt design. How long term, what currency, fixed or floating rate, straight or convertible. And the answer doesn't come from me, it has to come from you looking at your projects. And then I'm going to ask you a final question, which is, tell me what else affects your cash flows, and I'm going to try to be creative and bring it into your debt. Let me explain. You're a gold mining company. What's the biggest factor that drives your earnings and cash flows year to year? The price of gold, right? Wouldn't it be neat if I could tie the coupon rate on your bond to the price of gold? The price of gold is $1,000 an ounce. I'm willing to pay 10%. But if the price of gold drops to 400, my coupon rate goes to 4%. You're saying, you can't do that? Sure you can. In fact, the very first commodity-linked bonds were issued by a gold mining company called Sunshine Mining in the early 1980s. And they tied the coupon rate to the price of gold. Do you see what your benefit from this is? You can, as a commodity company, go out and borrow money. The biggest fear you have as a commodity company is, if commodity prices collapse, how am I going to service the debt? Now that problem kind of eases because you've tied the coupon rate to the price of the commodity. In fact, one of the things that has always puzzled me is why smaller oil companies, I can understand the big oil companies not doing this, why smaller oil companies never took advantage of this feature. You know, that shale oil company that went out and borrowed money to put out more oil production in North Dakota when oil prices were $120 a barrel. Why would you tie? You're saying, who'd buy the bond? Somebody will buy the bond. I mean, it's at the right price. So you're not doing this to pull a fast one. You're passing the risk on to somebody else. And you're doing it because you can't bear the risk. It'll essentially push you into default. So that's the first example. Here's the second one. About 15 years ago, somebody went through this class, went out, got a job at Allstate. Actually, she got a job at an investment bank whose client was Allstate. So one of the first companies she got as soon as she got on the desk was Allstate, and so she does the optimal debt ratio, she puts it through the spreadsheet, comes up with the conclusion that the company is massively underlevered. She calls me all excited now. Did the capital structure, I've got a 30% optimal, the company is only 5% debt. And I said, what do you plan to do? She said, we're going to fly out for a client presentation. We're going to tell them. She said, I'm going to tell them that they have excess debt capacity. I said, okay. Call me back after you've told them and tell me what happened. So she calls back a week later, completely forlorn. She said, I went in and I told them that excess debt capacity. So what did they say? They said, we know, but we're not going to borrow money. So I said, did you ask them why? And she said, yes. And this was their answer. We're always one disaster away from bankruptcy. You know what they were talking about, right? You're a big insurance company. You're one hurricane in Florida, one earthquake in California from essentially flipping from being this nice healthy company. You said, we can't borrow money because right now we have the capacity to borrow money, but what if there's a disaster? So be creative. Can you design a bond for an insurance company that allows them to get the tax savings, but also protects them if there is a disaster? Michelle, try it out. Tell me what you do.
I would get them reinsurance.
You could. That's one. Is you can reinsure, and there are and many of them are offshore, so you can get them reinsurance, which effectively passes it on. But is this reinsurance is like future, using derivatives markets? It's continuous, right? Is there a way that I could bring some of it into the bond itself rather than going into the reinsurance market? Have you ever heard of catastrophe bonds? They're called cat bonds. And basically they're issued by small insurance companies. And here's what makes them unique. The coupon rate on the bond is tied to whether a catastrophe happens. And of course, this is written by lawyers. So catastrophe will be very specifically defined as an earthquake that measures more than 7 in the Richter scale and creates more than 10 billion in damage. A hurricane. So basically, it'll be a whole set of clauses. And if the catastrophe occurs, here's what is built into the bond. The coupon rate the coupon payment can be suspended for 2, 3, 4 years legally. So you can't sue them for not making it. And the principal payment can, in some cases, even be reduced. Sounds great for the company, right? But what's in it for the people who buy the catastrophe bonds? What do they get in return? They get much higher interest rates. This is not a free... Again, we're not doing this to fool anybody. What we're doing is passing the risk on to somebody else. And again, my view is if you're doing something continuously, like using options and futures or using reinsurance on a regular basis, if you can bring some of it into your regular financing, it takes a little bit of the burden off. You still have to use reinsurance and futures and options, but it's almost like, how you finance working capital. There's a permanent part that we finance with debt, and that's the way I think about risk. The more you can bring into your existing financing, the less you have to worry about on a year-to-year basis. So that's the first stop, is you've stopped and designed a bond that looks like a stock, right? That's really what you're doing. You're designing debt that looks like equity. That's a great, in fact, you might have done such a good job that you might have actually lost the battle. Let me explain. Let's say you designed this financing, incredibly flexible financing. Okay? In fact, insurance companies also have things called surplus notes. Have you heard of these, where coupons get paid only if you generate profits? So it looks like, looks like equity. In fact, you've done such a good job, the IRS takes a look at it and says, you know what? That looks a lot like equity. So we're going to treat it as equity. So the second stop is to make sure you haven't been too clever for your own good. Stop at the tax guy's office and make sure that what you've designed is actually still going to pass muster as debt. So this is also your last chance to massage this financing to maximize your tax benefits. So if you're a European company, you don't want your interest expenses going to Ireland. So if you have to design the bond in such a way that the interest expenses go to Germany, that's what you're going to do. So you're looking at, essentially, this is why you need a tax law. You try to do this on your own, you're going to go crazy. So you've got to stop and make sure that you pass muster, you get those tax benefits on those payments. Okay? So there are very specific aspects of the tax law you've got to be familiar with. For instance, when you issue a zero coupon bond, if you're a logical thinker, you say, I have zero interest expenses every period, so I have zero tax benefits. That's not the way it works, because what you have to do is take the difference between the face value and what you issue the bond at and amortize it over time. So you have to be familiar with how the tax law works to make sure you can make. So in a sense, you can't lose that tax benefit, because if you do, then this whole process breaks down. So you've designed the perfect debt, you got the tax okay. Third stop is an interesting one. As a company, there are all these different groups of people you got to keep happy, right? So let's say I'm a company. You guys be the ratings agency, you guys be stockholders, and you guys be equity research analysts, you be the regulator. So I'm an insurance company, a banking company, a regulated company. So I've decided to issue a security next week. Okay? So first stop, I stop at the ratings agency. You care only about default risk, right? You want me to reduce my default risk. So when I issue a security, what do you want it to be, debt or equity? You want it to be equity because equity makes me safer. So I convince you that the security I'm issuing next week is equity. You're saying, what's the big deal? Then I come in front of the equity research analyst. Now, when I issue equity, what happens? Why does it freak them out? Because when I issue equity, the number of shares goes up. The delusion bogeyman comes out of the closet. Push him back in. Say, so now I've got to take that same security that I convinced you was equity in the morning, and now magically I've got to make it debt for you. It's quite a trick, right? Then I go to the regulatory authorities who look at my regulatory capital ratios. And if they're looking at regulatory capital, do they want me to issue debt or equity? They want equity. So magically, the same security went from equity to debt back to being equity. You think, no chance, that's impossible. Hey, there's no harm trying. In fact, I would argue that a big chunk of money made in corporate finance and investment banking often comes from threading the needle of different definitions used by different groups. So let me give you an example. Okay? I'm going to describe to you a security, and first I'm going to ask you, based on what we've talked about, debt and equity, tell me which bucket you'd put it into. Then I'm going to talk about what actually happened and then the consequences of it. Okay? So here's what the security looks like. The security comes with a fixed dividend. So right contractually, there's a dividend on it. That fixed dividend is tax deductible. And if you fail to make that fixed dividend, you got to turn over control of your company to me. Fixed dividend, tax deductible, loss of control. What does it look like to you? It looks like that to me. In the early 1990s, there was a security called trust preferred that met all of these criteria. And the investment banker who created the security pulled off a coup where he got the ratings agencies to classify it as equity. So I actually talked to one of the people on that panel, classified as equity, and said, this makes no sense to me. Why do you guys treat it as equity? And he gave me two reasons. One incredibly stupid and one mildly stupid. And I'll let you decide which one is which. He said, first, we called it equity because it was called preferred stock. Is the opening you've let for me? Let's go on a renaming convention of the balance sheet. That bank loan, we no longer call it a bank loan. We call it bank preferred stock. Corporate bonds? No, that's not the right word. You can't classify something as debt or equity based on what it's called. That's the incredibly stupid reason, in case you're wondering. The second one had a milder level of stupidity. He said it didn't come with the maturity date. Do you see where he's going? Debt usually has a finite maturity. Equity lasts forever. Because trust preferred lasts forever, it's equity. And here's my counter to that. What did I say Boeing issued in the late 90s? 100-year corporate bonds, right? Let's say you buy a 100-year corporate bond at issue. Unless you're an incredibly optimistic person, you're probably not going to be around to collect the principal, right? So you're really not even thinking about principal, you're just thinking about coupons. You see where I'm going next? If you decide to classify something as equity based on maturity, why shouldn't I make those 100-year corporate bonds into 1,000-year corporate bonds or even perpetual corporate bonds? In fact, there used to be government bonds which lasted forever called consols that the British government used to issue. They're probably still around there. You bought that bond, there was no maturity date, you just got a coupon every period. And if you want to treat something as equity based on maturity, then I'm going to go really, really long term and make all my corporate bonds perpetual. Maybe I'll have to pay a slightly higher interest rate, but I'll get a AAA rating while I'm doing it, right? Because you're going to say, congratulations, you just issued equity. So the reality is that this was debt, but it was misclassified in my view as equity. But you can see already, if you do that, what you're going to create in the market, right? It looks like the best of both worlds, right? You as a company can go out and borrow money with trust preferred. You can get all the tax benefits of debt. And while you're doing it, your rating keeps going up. And to add to the attraction to the investment bankers, what you made on trust preferred was about 10 times larger than what you made on issuing straight bonds. So if you went to work for Goldman Sachs or Morgan Stanley in the early 1990s, you'd have an incredible pressure come on you to sell trust preferred to everybody who walked in through that door. company walks in, trust preferred is the right, you wouldn't even look at what they were. Trust preferred, right security for a UPS guy walks in, how about some trust preferred? You want to issue, so in a sense, trust preferred became the coin of the realm. So there's no, as low man on the totem pole or low person on the totem pole, you can't fight this. So let's assume you resign to the fact that you're going to have to sell a lot of trust preferred to make your bonus this year. But you want to create the least damage you can while you make your bonus, which is a good objective to have. So I'm going to ask you which of the two groups I'm going to describe to you is a better target for selling trust preferred if you don't want to create long-term damage. The first is a bunch of firms that are underleveled. Underleveled in what sense? They can afford to borrow more money, but they have a rating constraint. Remember we talked about companies putting in rating constraints, single A, A+. It might come out of nowhere, but they've said that's my rate. So they're not borrowing money because they have a rating constraint. How would trust preferred help them? They could issue the trust preferred, move to their optimal, and because the rating agencies are playing this silly game, your rating would still stay at A+ or AA. So that's the first group. The second group of companies are overleveraged. They already have too much debt, but they might be able to slip in trust preferred and nobody will notice that they're issuing debt because the rating agency is looking the other way. Which of these two groups is a better target for you? A or B? I would say A, and here's why. Because they're underleveraged, they have the capacity to service the trust preferred. They can meet this artificial rating constraint and get away with it. Why not? Why is the second group overleveraged? What does overleveraged mean? They have trouble making their debt payments, right? That's what overleveraged means. It's not some abstraction. And what have you just done? You've issued trust preferred, and you now have to make that preferred dividend on top of the existing payments. The only consolation price I can offer you is when these companies go bankrupt, they'll go bankrupt with a really good rating. You're still bankrupt. I think sometimes, especially when you're providing advice to a company, this becomes a game. What can we do to fool the ratings agency? Okay? And that's what trust preferred was. It was a security created to, in a sense, fool the ratings. And it worked really well. Until the ratings agency finally caught on. It always happens. As I said, ratings agencies are always late to the party, but eventually they get there. So by 97 and 98, ratings agencies were starting to treat trust preferred as debt. Or mostly debt. So guess what investment banks did? They came up with newer securities. In fact, the way I describe this is what they're doing is actually creating degrees of separation between a company and its own debt. In a traditional company, you borrow money. There's no separation. This is your debt. You create degrees of separation, hoping that if you create enough degrees of separation, people will stop noticing that you borrowed money. And if you keep pushing that debt further and further away from the company, you know what the end game is going to look like? It's going to look like Enron. I know Enron is full of crooks and all the other, so there's all these stories about Enron. But I'm convinced that in 1999, if I'd walked into Enron, into the CFO's office, and said, how much money do you guys owe? They would not have known the answer. Why? Because they'd done such a good job of separating themselves from their own debt, they had lost all sense of how much they owe. You think this is a dangerous place to be as a company, to not know how much you owe? Or let me rephrase this. There's this old riddle around that I've never understood what the answer is. So it's, if a tree falls in the forest and nobody hears it fall, did it actually fall? This is the kind of thing people come up with and have nothing better to do. But I decided to steal it anyway. And let me ask you the question in a different format. If a company borrows money and nobody knows they've borrowed money, have they borrowed money? That's kind of a mind twister, right? Well, there's one person who knows you borrowed money. You know who it is? The guy who lent you the money. So the ratings agency might be looking, everybody might be, the analyst might be clapping, but ultimately, the guy shows up and says, you owe me money and you can't pay, the game is over. Don't make this a game. And that's part of the reason you want to constantly refocus on what a company can afford to pay. Not on, 8 times EBITDA is okay, 6 times. These rules of thumb often miss whether a company can actually get away with borrowing that money. So now you create this perfect bond, you got the tax okay. You got these different groups, if not delirious with joy, at least okay with what you're issuing. You get ready to issue the bonds and you discover that nobody will buy your bonds. You see, why not? For one or two reasons. Either you have no history in the bond market because you've never issued bonds, so they don't trust you, or you have a history and it's a wrong kind of history. Let me explain. Remember the Nabisco story I told you in the very start about Nabisco going out and doing this leverage buyout and screwing over their bondholders? That was in 1987. 4 years later, Nabisco went back public and tried to issue bonds, and nobody would buy their bonds. Why? They remember the name. I remember the last time I bought your bonds, what happened to me? I'm not buying your bonds. Bond markets have much better memories than stock markets. Stock markets get fooled every 6 months. That's the, trader doesn't even remember the last time the stock was out, the fact that he was fooled. No problem at all. Bond markets remember. So you either have no history or the wrong history. People are not buying your bonds because they don't trust you. So what you have to do is sugarcoat your bonds to make it acceptable to bondholders. What does that mean? You've got to add protections. Against what? Against things like leverage buyouts. Remember we talked about puttable bonds, convertible bonds. What you're doing is essentially adding sugarcoating to the bond, saying, I know you don't trust me, but here's what I'm going to give you as protection. In fact, Merrill Lynch in the late 80s came up with what were called rating-sensitive bonds. Sounds fancy, right? What they did was they tied the coupon rate to whatever your bond rating was. So if your rating today was AA, the coupon rate would be 4%. But if tomorrow you did something stupid and went to B+, your coupon rate would rise to 11% to make up for it. You're not doing this again out of the goodness of your heart. You're doing it because if you don't do it, people will assume the worst about you and charge you a really high interest rate. We're almost there. You've designed the perfect bond. You got the tax okay. You got these different groups reasonably happy. You've sugar-coated the bond just enough to issue it. And then you make your final stop. And here's what you have to make sure you don't do. If the market's making a mistake that is working against you, don't lock that mistake in. Let me be more specific. Let's assume that S&P has given you a rating of BBB. But that based on your financials, it should really be AA. They've underrated you. You know they've underrated you. You feel sure that they've underrated you. The right kind of debt for you based on your physical assets is a 30-year fixed rate bond. Don't issue the bond right now. You see why? If you issue the bond right now, what's going to happen? People are going to price it based on the BBB rating. You're going to pay too much in coupons and interest. So this is a case to be made for issuing kind of bridge financing and try to convince the ratings agency to change their mind. It might not work, but you don't want to lock in market mistakes that work against you. What if the market mistake is in your favor? You see what I mean? Let's say you should really be a BBB rated company and I give you a AA rating. What are you going to be tempted to do? Go ahead and issue debt. You say, do I need the money? Who cares? In fact, I get variants of this question at technology companies, especially in today's market. And it's not about bonds. It's about their shares. So let's say you walk into, I don't know, you can pick the company. Right? Some young, high-flying tech company whose price has gone from 10 to 95. The CFO calls you into his office, closes the door, pulls down the blinds, and he says, can I tell you something? Which your answer should be, please no, I'm leaving right now. Okay? He says, my stock is trading at 95, and I really think it should be trading at 30. You see what's coming next, right? Should I go out and issue as many shares as I can at 95? It's a generic question. If the market's making a mistake in your favor, should you take full advantage of it? When you do, who's benefiting? Take this case of issuing shares at 95 when the stock, what do you think the fair value is? 30. Well, it's shareholders, but not all shareholders, right? It's a subset. The existing shareholders benefit. The new shareholder, there's no shareholder value created. What you're doing is you're transferring wealth. And my answer to them is don't do it. And here's why. For two reasons. One is you do issue the shares at 95 and you're right. What's going to happen? Eventually the price is going to drop to 30, maybe in the next 8 months. And a year from now, when you go in front of that annual meeting, guess who's going to be sitting in those chairs? Half of them are going to be filled with people who bought your shares at 95 and they're going to be really pissed off at you. So I said, self-interest, don't mess with it. The second is you go out and issue these shares when you don't need the money. The cash comes into the company, right? You're saying, so what? You have a lot of cash sitting in the company. It's going to burn a hole in your pocket. You're going to be tempted to do really stupid things. So I know that companies are often tempted when the market price, and this is true for startups too. If your VCs are attaching too high a value to you, You're going to go out and start to collect as much money as you can while the value is high, saying, what if the bottom falls out? Just be careful about the game you're playing. Because those people that you're raising the money from today might eventually be the people you have to answer to 6 months from now or a year from now. So that's the entire process. So the last 6 pages captured in. And this is why I think you can never turn debt design over to somebody else. My problem in a lot of corporations is, here's how debt design works. A company decides to borrow money. They call in an investment banker. Say, tell us what we should issue. The investment banker comes in with his portfolio, opens a case and says, I have exactly the right debt for you. This is silly, because I know exactly what he's going to pull out of his portfolio. And this is not because he's a bad person or she's a bad person. The investment banker is a very different set of interests. So who knows your company better than you do? It's your job to assess the right debt for you rather than have somebody else do it for you. So when you get a chance, sit there with your company and start thinking about building the right debt for your company. So here's what I'm going to do to kind of complete this part of the process. I'm at least going to take you through 3 different ways in which you can design the right debt for your company using the framework that I developed. I'm going to start with a very intuitive approach, kind of an extension of what we've talked about. And this is what I think the bulk of what you should do should be as well. Think intuitively. Think about what your company does, and you should be able to design the right debt for the company based on what it does as a company. Second, I'm going to give you something that is a little more numerical, where if you have a big project, Shanghai theme park, and you say, well, how will I come up with the right debt for it? I'm going to give you a way in which you can take the numbers used in your capital budgeting and use it to actually tell me what the right kind of debt for your company is. And the third is, I'm going to argue that maybe if you can tell me what macro variables drive your earnings and cash flows over time and your value. So if interest rates go up, how does your value? I could actually design the right debt for you based on how your company moves with those macro variables. Sounds mysterious, but let's start simple. Let's take Disney and let's break it down by business and design the perfect debt for each business just based on what we think a typical project looks like. So let's start with the movie business. Typical project in the movie business is about 2, 3, maybe 4 years long, so it's typically short term. For a long time, Disney's movies tended to be very US-centric. So the cash flows used to be in US dollars. That's obviously changing. The Star Wars movie, for instance, 50% or more of the revenues are going to come from outside. So you're going to look. So now, increasingly, it is more global. And one aspect of the movie business that makes it different from most other businesses is it's heavily skewed. What I mean by that is if you have a few big winners and lots of small losers. How can you tell? Just get on Netflix and just start looking at the list of movies. And you say, I never heard of that movie, never heard of that one. Those are the movies that came and went and didn't even notice them. A week in the movie theaters, they're gone. And that's true for a lot of movies. So if you look at every summer, the top 10 movies of the summer account for 90% of the gate receipts. So if I were designing the perfect debt for the movie business, it would be short term. Increasingly mix of currencies for Disney. So if it's a Star Wars movie, I'm going to be looking at a mix of currencies because that's where they get their revenues. And if I can, I'm going to tie the coupon on that debt to how well the movie does. This is obviously less critical for a Disney, which has lots of movies. But if you're a Lionsgate, is the last of the Hunger Games coming out soon? Or it's all done? I forget now. But this is a studio that got a big chunk of its revenues from one movie. Can you imagine financing that movie expecting to be a hit? And you borrow money and the movie doesn't work out, you could go bankrupt. So you're tying the coupon, if you can, to how well or badly the movie does. Again, it sounds outlandish that people will buy a Star Wars bond or a Hunger Games bond. Have you heard of Bowie bonds? You know who David Bowie is, right? The guy who just died, spiky hair, crazy look, sounding music. The early 90s, David Bowie actually had a fight with his record company and he bought back the right to all of his music, which left him with a cash flow problem. And if you're a rock star, cash flow problem, those two don't go together. How do you maintain the 6 rolls and the 10 houses? So he approached an investment banker in New York who actually issued bonds against future revenues from his music. And what made Bowie bonds unique is the coupon rate on the bond was tied to how well or how many. In those days, it was all records. So basically, we sold, if 5 records went platinum, the coupon rate would go to 14%. Tomorrow, we all woke up and said, that's awful music. We're not buying it again. The coupon rate actually dropped to 0%. The coupon rate was tied to how many records he sold. If David Bowie can sell bonds based on his music, I don't see why you couldn't structure bonds on pretty much any aspect of what you do. Again, all you're doing is you're still issuing debt, you're still getting the tax savings, but you're making it flexible. Now, if I look at the broadcasting business, also typically for Disney, these are short-term projects. And here, the success of their shows, it's mostly US still. It's still very US-centric in the broadcasting shows. It's tied to ratings, right? Not bond ratings, but Nielsen ratings. So if you're designing a bond for a broadcasting company that produces 2 big shows, House of Cards. Let's assume that the producer of that, I know Netflix, actually, but let's say that somebody is producing House of Cards. You could tie the coupon rate on the bond to how well the show did. Theme parks, that's obviously Disney's longest term projects. And if you're issuing 100-year bonds, those would be the assets where I'd expect the 100-year bonds, because their theme park, remember, projects can last 50, 60 years. And a 100-year bond could actually end up being just right for a 60-year project, as you're going to see when we talk about project financing. Consumer products is kind of a mix. Disney actually licenses its consumer products now. It doesn't actually produce most of them, so it gets this big, predictable stream, which means not only can they borrow more, but you can tie it very specifically to how your licensing is set up. The interactive gaming business, if it ever issued debt on its own, this would be the place we'd expect to see a lot of convertible debt, because by itself, this division can't afford to borrow with a lot of fixed rate debt. So what I'd like you to think about, and we'll stop with this, is I'd like you to take your company and very generically, if you have just a single business, if you're Walmart, every project looks like every other project, then you might say, this is a typical project for Walmart, a new store that's leased. This is the kind of debt. And guess what? For retail firms, see why leases have always been the preferred way of financing? What does the lease do? It ties the debt to the project. And if the store does really badly, you escape from the lease by saying, you can't default as a company. You can actually give up on a lease and shut a store down. So the reason why companies evolve the way they do. So try this out for your company. And we'll start next session. We'll look at more numerical ways of coming up with the optimal type of debt for your company.
Why would a ratings agency ever treat something as equity that IRS decides is tax deductible?
Because they have different definitions. Their view is that we get to decide what equity is. So what the IRS decides is debt comes with the criteria the IRS uses for debt and equity. You have different sets of rules. So basically, most of the time, you're right. What the IRS calls debt, but when you create these new securities that people don't quite understand, you have 2 groups wrestling with it, and in this case, they got the best of both worlds. They got the IRS treated as debt and the ratings agency treated as equity.
The IRS could have other incentives to give tax breaks, accelerate depreciation or something that's not really about deciding whether it's
it could be specific to, is it real estate? Congress passes a law that says you have to give a tax saving. You might end up having to give a tax savings even though fully well you know it's really equity, right? So you can get, so the IRS is driven by the tax law.
Different motivations.
Different motivations.
That makes sense. And then for Disney, you were saying movies are generally short and things like that, but what about they're still selling Lion King DVDs and girls are dressed up like Snow White from 1938.
There are animated movies, you could actually argue. Snow White was 1938, right? They still make money on Snow White. Yeah. So maybe on the animated movies, you could argue that the life of a movie, and same thing with Star Wars, that the movie life is not just coming to the theaters and being released, it's all the merchandise that comes out of the movies, which could make their movies really potentially long-term assets. And you could argue, therefore, when I fund the movie, I'm going to be using long-term debt because for me it's not the movie, but the movie plus the merchandise plus all the other stuff that comes out.
Okay, thanks.
Hi, how are you?
Question. So I'm doing Boston Beer Co. and they have very little debt, so very little interest expense. So for now, I've been using the cash paid on note payable and capital lease as my interest expense.
Okay.
Is that okay?
It won't make much of a difference anyway, right? Because the market value of the debt, the only place it gets used is in computing the market value of the debt.
Yeah,
Right? Do you have lease commitments?
I do.
That's going to be the big number then. So that's going to drown out whatever you do there. You could make this zero, and the lease payments will still drive everything that happens.
See, the reason why I was confused is because my rating is triple B,
That's because of the lease payment.
the lease payment. So should I just use the lease payments and zero out the cash
No,
paid?
the lease payment, when you put it in the rating spreadsheet, the lease payment, the rating spreadsheet actually converts the lease payment into debt, calculates an interest expense on the lease, and actually create a synthetic coverage ratio based on leases being treated as debt. So it does what the ratings agencies do. So if you count that as debt, interest expense, and you do the lease thing, it'll double count.
Yeah.
So let the lease conversion take care of it.
Okay, got it. Thank you.
Hey, how are you?
I had a quick question regarding your the conversion spreadsheet. So the way in this, I only have a lease debt, right? But now I'm looking at the way the pre-tax cost of debt is here, computed compared to like how I computed it.
How do you compute it?
So I did it as I took the 10-year Japan, like the bond, took out the sovereign spread, and that gave me the risk-free rate, right? And then I added just the rating-based default spread out to that, right?
Do you have a rating?
Well, I computed the synthetic
How
rating.
did you come up with the rating?
I think on one of your spreadsheets with the, actually it's the same one. I think in here it computes it as well.
And this one converts the lease debt
So
into...
that's what I'm thinking. So this default spread that it puts, right?
Right.
It's actually not just the rating base. It's rating base plus the sovereign spread, because the rating
it
base
does.
spread is only 0.75, right?
Yeah.
And I'm getting a
Yeah, it adds a good, so it adds both.
So, but I thought your cost of debt is only your risk-free rate plus the company's.
No, not if you do a synthetic. You have to add the country spread as well. So if I take a AAA rated Venezuelan company and I do it in dollars.
Because I thought the company base kind of.
No, but it's not. If you have,
incorporates
let's say I'm doing a Venezuelan company in US dollars, right? Let's say I get a AAA rating for it.
Okay.
Would you tell me that it can borrow money at 2.5%, which is what the AAA,
But what if I'm not doing it in dollars?
doesn't matter, right? The country spread is going to show up in whatever currency you pick it in. Because if you took out the default, if the way you computed the risk-free rate
Yeah, I took
was
out
to
that.
start the government bond, you took it out. So if I take Venezuela and I take the Venezuelan Bolivar rate and I take out the default spread, I have a risk-free rate in Bolivar. But that's because I took out the sovereign spread. And I want a cost of debt in Venezuelan Bolivar for a company. I have to add both spreads back.
Well,
Do you see what I'm
I
saying?
thought the company spread kind of takes that into effect,
No.
like how.